cool myself. Let's look, how do we look at these positions? How do we look at these positions? Well, we've talked about a few rules for our bookie position. Number one, what market is our favorite market for doing these positions in? It's the Treasury bond market, right. In your bookie manual, we'll also talk about our rules for doing it in two other of our favorite markets, which is the cattle market and the soybean market during 6 months of the year. We don't do it during the summer months in soybeans for obvious reasons, and for reasons we've had this year where we've had some pretty good spikes in the corn and soybean market. But during the winter months, we rarely, if ever, have a big move in soybeans, and we talk about that in our manual. But our favorite market is still always the Treasury bond market. Still always the Treasury bond market. That's number one. We picked the correct market. Number two, we want to sell options that are above the 6-month highs and below the 6-month lows. Number three, you're going to see some other rules in your manual that talk about how much premium we want to get. If we sell a 90-day option, we get a certain amount of premium. 120 days, a little more premium. Okay. We're also going to tell you exactly how many options to sell. Now, someone talked to me before at one of the other seminars we had, and he said, well, these positions are so great, and if I have a $15,000 account, for example, and the margin is $1,500, I should just do 10 of them. Well, again, 70% of the time, that'd be great, and you'll make a huge profit and a huge return on your margin because you'll have collected the maximum amount of premium. But what happens when the market starts to move? And looking at the chart, we're going to actually put this up for another reason, but let's say you initiated neutral positions in this market below the lows and above the highs, and that market made a big move. Well, what would have happened to you if you initiated the maximum amount of positions is you wouldn't have had enough money to adjust, because you'll see in our manual under the rules under adjustment that we add additional positions when we adjust. So we always want to have enough money available to adjust, and we like to have enough money available to adjust 3 times, just in case that market really begins to move. And there's been a lot of studies done by people that have talked about when do you make your best returns and when your best chance for making money. And you know what? It's the same for gamblers as it is for traders. The more money you have, the higher your probability of success. So if you're going to start with a limited amount of money, let's say $15,000, $10,000, $20,000, even $100,000, and you don't have enough money to add on indefinite amounts of capital, then to give yourself the best chance, you want to start with a small amount of positions. A small amount of positions. Now, I don't care if you call me and say, well, I could have made a lot more money if I didn't listen to you. As long as you made money, I'll be very happy. Because the other side of that call is, the market went against me and I couldn't adjust. Well, when that happens, it's too late if you don't have enough money. And probably the best example that I can think of is if you consider why Las Vegas has limits. Most casinos have limits on the amount of money you can bet. Now, why should they have limits? Because generally the casino's advantage runs from 2 to 15% in a typical game, and instead of just taking small amounts all the time and making their advantage, why not let you bet up to $100,000, $500,000, $1 million? Why not just keep on going? Well, the reason for that is the casinos know that if you had the ability and the funds to keep doubling your bet and keep increasing your bet, that the odds would eventually be considerably in your favor. Now, yes, you would be risking a lot of money to make a little bit of money, but the odds would probably be 95, 98% or more in your favor. Okay? So the casinos have an easy method of preventing that. They put limits on the bet, so you can't keep edging up. But you know what? You can do that. You can virtually do that in the type of option trading we do by keeping your position size small. Okay, let's say you've passed your first year of trading successfully, and what we recommend, by the way, is the first 2 months, at least, you paper trade, and you don't put your own funds in. Just trade it on paper. Now, you're going to get, with with a seminar and with any course that you might get from us, you're going to get a sheet where you can actually enter all of your trades, and you can enter the trade and the result, and if you needed an adjustment or exactly what happened. So you can see the results of every position you do. Unless you can trade for 2 months profitably in a row, we don't recommend you actually trade yourself, because then you're doing something wrong. If you can't get at least 2 months in a row of profits on paper, don't trade. Don't trade. Again, the markets are always going to be there. The opportunities aren't going to fly away and never come again. They're always going to be there. But if you lose money, you get disheartened, then you might not want to continue. So I want you to paper trade for 2 months. Okay? Let's say you've gone by the paper trading period, and you've gone by, and then after you paper trade, I've told you to trade small. Let's say you've gone by all that. Let's say you've traded for 6 months successfully, and now you want to get up to your proper position size. And let's take an account of $25,000. Let's have an example of $25,000. $25,000 account, we would probably recommend somewhere around 5 bond neutral positions to start with. Okay? The margin on that is going to be about $5,000 to $8,000. So you have enough margin to adjust that position 2 or 3 times and add on each time if necessary.